I'm not like Democrats and Republicans on either side that it's just a simple bumper sticker and my way or die. There's all kinds of ways in between.
Oh, well, we were set to attack you the entire time.
VC founders are just fine if they know what drug they're taking.
The drug of money.
Most founders don't know that 70% of traditionally VC funded, that safe Series A, Series B kind of game, don't really pay off for the founders.
Well, I'd never describe founders as normal.
I think a really good founder with a half-ass idea can make it happen.
There's many ways to play this game. Choose wisely.
Hey everybody, welcome to the Cheat Code.
Hello and welcome. You're back again on the Cheat Code and Friends. I'm, of course, joined by my two normal or my steady friends, as I'll call them, Josh Wagner and Sean Kester. Gentlemen, welcome back to the show.
Yeah, great to be here. I'm happy to be a steady friend.
Yeah, and then I shouldn't frame that. There's no proper way to frame it because Mr. Greg Head, who joins us today, is a longtime friend. I forget Greg when we even met originally. So we're all steady friends here today. But Greg does a ton of work through a group called Practical Founders. I'll let him kind of give the backstory on that and so on. But I would say, I guess, Greg, how would you frame it? I'd frame it as, efficient growth is definitely a staple there. And well, maybe just take it from there. Like, what are you guys up to at Practical Founders?
Well, it's me and all the automation and team around me. After 30 plus years, I stopped incrementing the number there in the software business. These days, I help serious SaaS founders all over the world who are building valuable software companies without big VC funding. So there's two qualifications there. I played the VC funded game for a long time, grew two companies to 100 million, won that game, lost that game. But now there's many ways to play the software game and many levels, and you guys play in a certain tier of it as well. I just started seeing the results of and hating the myth that VC funding is the only way to do it, especially in the last 10 years when the cost of making software is going down, the cost of going to market has gone down if you know what you're doing, and VC funds have gotten bigger. So there's still a crazy lane for the, go big or go home, VC funded Series A, B, C, D, E, et cetera game. There's some challenges with that, new opportunities with AI, but there is a whole horde of serious, capable software B2B SaaS founders who are doing it bootstrapped, a little bit of funding, a little bit of non-dilutive funding. There's all kinds of practical approaches in there, and there's many ways to play that game. So it's much more varied. And I work with about 40 founders, either one-on-one with my advisory or in my Practical Founders CEO peer groups. I just had one of the meetings today. I've got about 30 founders who work together, and they're all in common. They're serious, they're growing. They're between 1 and 20 million. Some have grown up over the years, and others are just getting on the chute. That's generally the swim lane I focus on. The VC-funded founders are just fine if they know what drug they're taking. But they're just generally overserved, and there's plenty to help for them. And
The drug of money.
yeah, well, it's, the VC funding is kind of a drug if you don't take it wisely. And the Silicon Valley approach is, more funding, stuff them full of funding, keep stuffing them full, see how fast you can grow it. And most of them don't make it literally alive, but some do and make it big. And there's a place for that in the world, and certainly part of our U.S. economy. So
yeah, what comes to mind as you're kind of giving that explanation there is, also the average age of most founders, which tends to skew pretty dramatically to, the young, right? And when I think about certainly one of the most perceived differences between, a VC backed founder and a bootstrap founder, at least stereotypically, is their ability to steward money and to really think about the almighty dollar as their own versus something that was simply, added to a business like a tool or a piece of software and so on. So I definitely want to get into that a bit, but I'm curious just with because when you said all over the world, like that's a true statement, right? Like you've got a lot of international representation within that cohort, right?
Yeah, I mean, if you look at people from Silicon Valley think, oh my God, there's people out there who don't raise as much money as they can and keep raising. And the reality is, it's just the hidden majority of software companies around the world. I mean, there are probably as many startups in India, software startups in India, as there are in the US, and almost none of them are VC funded. Same with Europe. The VC funding game isn't played the same. There's more funding out there as well. And if you get us outside of Silicon Valley in the US, the majority of software companies don't have big institutional capital and trying to be unicorns. So there's a place for that. Not everybody needs to get into Harvard, Stanford, and the top Ivy League schools. There's a place for it. It just isn't most founders. So yeah, they're all over the world. And I was talking to people today from all over the US and Canada and Poland and the UK in my group. So, and they're all normal founders as you would describe them, and they're very disciplined about how they think about their own money and the efficiencies in their business and where the leverage is and all of that. So,
Well, I'd never describe founders as normal.
yeah, they're normally abnormal. Practical founders means reasonably crazy. So it's just a swim lane off the totally crazy.
So I'm curious, just to kind of level set the focus of the group, how do you evaluate, if someone comes to you and says, hey, I'm interested in joining this group, I'm interested in your perspective. You've got to have like you said, a common thread there in terms of the desire for growth. Certainly, they're just choosing to finance the business in a different way. What do you look for?
Yeah, they're at the same time serious about growing their business. And they know the magic trick that if you get your B2B SaaS business growing 20, 30, 40%, and sometimes higher, and many, do grow faster, it's hard. It's, and it can be brutal. And so it's not easy, and it's a tough puzzle and so forth, but you can definitely do it. The practical founders are just more, let's say, patient about it. It doesn't need to happen in 3 years. It can, we can compound at 25% for 7 years and get there and get a big win. So they're serious. They know the SaaS metrics and everything, or the SaaS content out there as well as anybody else. That's the myth that bootstrappers are the naive ones, not necessarily. They're serious about two things. One is, I'm going to find leverage in my business, and we're going to grow, and we're going to do the things to grow and get there without funding. I don't need it, and I don't want to take it. And I don't want to take it because I'm serious about doing it my way. These are very independent people. And, even though they could take funding, like plenty of the founders in my group, even this morning, have businesses over 10 million ARR. They could take funding, they could take exit, they could sell it all, they could be wildly wealthy, and they don't. They want to do it their way, and they want to keep growing the thing. And there's all kinds of variations in there. Not everybody's doing it the same way, but those are the common threads. If you're not trying to grow, then you don't need to change. You don't need to be part of a group. And, if you're VC funded, you're going to get a different kind of help and a different kind of formula. So there's different formulas where founders can win. I just think the practical founder swim lane, get a company to 5 to 10 to 20 million ARR and, continue running it like Jason Fried and Basecamp and for profit for the founders, or sell it for 5 to 10x, to the likely private equity owner or strategic. So it's plenty of ways to do that. And they're all good people. I'm kind of a hardcore, old frugal guy, even though I've played the VC funded game for a long time.
When you're giving them recommendations, what are there different metrics initially that they're marching to? Do they look at different things than traditional venture-backed funded SaaS businesses or CEOs? Are you recommending them to have a slower growth?
No, they're growing as fast as they can without losing control of their company. And, which generally means sometimes they're profitable, maybe taking money off the table and growing at a rate that makes sense for them and their market. Some markets don't grow as fast, and their GTM tool of choice. But other ones are just, let's say, closer to break even, plus or minus. And so they have optionality. They can sell it. They can go faster, go slower when they figure out what's going on. And the bigger thing is the pace. I don't have to grow at 50, 75, 100% a year plus, and because I don't need to, right? And I've done that game for a long time. It's pretty unhealthy when you're spending tons of money. It doesn't all work. You're growing faster than you can grow your teams and your leaderships and yourselves. and you sell it and the thing tops out. So it can work, but it's generally a little faster than most software founders and markets, especially in vertical markets. Most vertical markets don't grow that fast.
Yeah, I think that's a nail right on the head there. I think it's interesting to frame those comments even within the, call it the traditional VC space, which these days is anything but, and especially in early stage. And I've been talking about this with a lot of different managing partners over at VC firms, where you're kind of starting to see these interesting bifurcations centered around the concept of speed and growth multiples that are actually desirable. Like I said, especially in the early stage, like where we invest, which is, what we call seed stage investing, which for us is, revenues anywhere between 500K and 1.5 million. You're starting to see us evaluate deals and get feedback from founders who have spoken with other VCs where, those folks are looking for growth rates that are not just, 1, 2, 3x year over year, but 25, 50x year over year, right? Like, which is not sustainable. But you do see those mentalities starting to kind of diverge there. And AI is obviously the catalyst for this. You've got wide ranging, horizontal, eat the world potential solutions. And I think that's framing kind of a new category of VC, which is probably more looks like the stereotypes that we framed old VC around. And then you've got other folks that are kind of more vertically focused, which we are. And I've talked to a lot of those folks as well, who are just looking for solid 80% to 250% growth in those early stages year over year. That's still good growth for us. But you're seeing a lot of firms like really walk away from those types of trajectories and try to latch on to something else.
Yeah, you can win at any level, depending on your market and your approach and the founder and so forth. The odds go down the more you commit to 25x or triple, double, the old VC, math in the early stage. Most founders don't know that 70% of traditionally VC funded, that safe Series A, Series B kind of game, seed Series A, don't really pay off for the founders. So you're getting them a little bit later. There's a little bit of a flywheel starting to take shape. You guys can add your value to them. Presumably you have lower risks than.
Well, but that's the big difference there, I think, is the potential outcome, right? Because the folks that are looking for those 25, 50x year over year, like that's still an IPO destination. And you're getting a lot of other folks that are looking at how that space has performed. And geez, like
What space?
Right, exactly. Like, talking about like what last year we had one IPO. Now this year's been, things are ticking up a bit in B2B SaaS, but the outcome is much more realistic in that PE or strategic acquisition space once you get in that $50 million range. And I think that's becoming a new focus for a lot of founders.
Yeah, that's kind of our range. Is the founders I'm dealing with say, I'm going to grow this from 1 to 3 to 6 to 10 and, to be in the 5 to 10x range and see what my options are to keep going or do growth equity or private equity or a strategic sale or, something in between. So optionality is really important to my founders. But, that kind of shoot the moon math has always existed for VC funded. And it's just interesting. I think VCs have an interesting challenge. The IPO market's closed. And moats are different. If 3 people can grow something really fast in the early stage, then what's protectable once it's 300, right? Is it that week's LLM update is going to allow a competitor to come in and kill you, the next 3 person? So, I think that's what venture is betting that a few of these are going to get really big and be gargantuan. And there's still that's what AI is providing these days.
Well, let's kind of shift the focus from, VC to versus bootstrap into just, I'm curious to get, kind of evening around the horn. What do we look for in just great companies? Because I think there's probably a lot more overlap there than folks would expect.
So I think a great company, software company, they've got a ready market, meaning there are enough people out there that have a real problem with the old reaching demand. They know they got a problem. And this is still a product business, and AI is kind of bringing us back to the product business. So you've got a great enough solution for them, the old 10x better than the alternative kind of thing. and you're building your business in a way that's consistent with the outcome that you want to have, with the culture, with the end game, with the pace, with the efficiency. So there's all kinds of ways that founders can dial that. And doesn't mean it's vertical or horizontal or in the US or in Europe or India, or it has to get to 100 million, or it's a single founder or co-founders. The mechanics of a great business, I don't think, have changed, and AI is going to accelerate some of that. So that's what I think. And to me, I just think the founders have a right to decide what they want to do with this thing.
Mm-hmm.
Right.
So that's it.
Yeah, I was thinking that the product side, the problem side is where I always start, right? Like, is there a legitimate problem that everyone in your market says, yeah, that's a problem and I need a solution for it, right? So if you can't start there, then there's really no other way to start. And what I like about the AI evolution is that the product is starting to become a little bit more interesting. I felt like in the last, I don't know, maybe 6-7 years prior to this AI boom, there was this I'm making a better spreadsheet thing happening a lot. And it was like this incremental efficiency that just wasn't adding a ton of value. And to me, that's where the AI boom switch things was like, well, now we're adding a tremendous amount. The problem is there. And because of this product iteration, the value is an explosive amount of value that you can provide to the customer. So you wrap that around. So I think those are like the product problem type of things. And then the next thing I think about is just a founder that is able to create a culture of accountability. If I took those two ingredients, like that to me is the foundation for what a really good company could be, regardless if it's bootstrapped, venture backed, it doesn't really matter. You could really take that and run with it.
Yeah, I think all those things and probably double down on the founder. I think a really good founder with a half-ass idea can make it happen because they know who to talk to and where to go find the answers to it. I honestly do. And I think, I think the accountability part is really important, but I think someone who can think outside the box and think a little bit bigger and understand what the customer needs and actually have the patience to go find out what they need. I think a lot of times you start with the hypothesis, you go act on it, you get some early success, and you're like, I know how to take the direction of this company. I know which way we need to go. I know where we need to innovate. And reality is you're 99.9% wrong, or at least in my experience. And so I think it takes that and beyond that, it's being able to build a team around you to be able to go accomplish those things. And so you've got to be great at hiring. So I think at first you've got to be able to go understand what the pain point is that you're actually trying to solve, who to talk to uncover it, and then build a team around it. So I think, yes, you got to have a product. Yes, you need to have a need, but I think the founder or the co-founders are critical in that process.
Yeah, I think the only thing I would add to the conversation is go-to-market fit for me is just as important as product market fit, meaning if you look at the typical VC model, they are non-concurrent milestones on the timeline, right? Like, hey, I've got my product idea. I'm going to, get an MVP of that in market, determine, do I have a certain degree of fit there? And then I'm going to start worrying about how I'm really going to take that to market and scale that from a sales perspective. And I just think that's so important to, either develop those two concurrently or maybe even identify the go-to-market routes prior to really locking in on a product. Because I just see so many organizations coming up with this secret science in the lab. We're building the world earth-shattering thing, and then just go-to-market's a complete afterthought. And then what do? They do exactly what companies have been doing for the last 10, 15 years, and it falls flat, right? Because they haven't identified a unique route to market or a unique way to conquer an existing route to market. So that's probably the only thing I would add. I'd certainly double down on all the founder characteristics. I think even, harkening back to like, can you be a steward of someone's money? Do you care about someone's money as if it were your own? Do you spend it in that manner? And can you be scrappy in a business is hypercritical. I forget if you put this stat up, Greg, or where I found this, but the Cara came out with a survey in terms of the percentage of founders that are single founders versus, co-founders. Only 17% of VC-backed founders were, single founders. And that to me just was crazy because immediately it's indicative of the fact that like, okay, I've got an idea. but then I don't really know how I'm going to develop that idea. So I better go get some money and then bolt in someone else whose economics are probably different than mine. We're probably both reliant on a salary. That's just really that's a really difficult way to build an efficient business for me if you've already got to bring together a lot of these core components. I really prefer the individual that like has the skill sets to play a number of those different roles and can see the efficiency in that. And then maybe they take money, maybe they don't, but you got to start off with some sort of arbitrage, even in skill set, I think, to be successful out there. So that stat just kind of blew me away on the balance for Bootstrap, which is, I don't think I said it, but 17% for VC backed, 38% of Bootstrap startups have a solo founder. And I think that's a huge value add.
What are the others? 3 founders, 4 founders, or something like that? Or
good question. I've got the full survey here. Of the 40 plus SaaS IPOs, only 5 or so had solo co-founders. Blah blah blah. Also,
so they're targeted from IPOs backwards.
Yeah, exactly. I'll link this out in the show notes. They've got this broken down by a lot of different dimensions. But
yeah, I can see that over the years and recently, more founders, bootstrap founders, or solo founders own all of the company and have other people working with them. With the exception being, there's co-founders in the business, and I don't know whether it's the cause of the effect that VC funded founders are mostly, have founding teams, right, as co-founders. Because a lot of VCs say we don't invest in solo founders. It's just such a pressure cooker. We're going to throw all this money in. We expect all this growth. You need some help and a counterpart to, keep you sane through that. So, yeah, I can see that. I can see there's reasons for both of those.
Without taking money, do you find that most bootstrap founders have something of their own in order to start it? I mean, because you can't, if you have no money, you can't start something and get paid no money. So, I mean, so is it one of the prerequisites of them coming from having some money or?
There's all kinds of ways they start companies. It could be like Justin. I had a service company. I had profits and sold the service company. And I built a product out of that. You could have built products out of that. That's probably 25% of the practical founders out there and everywhere is they're deep in an industry selling the thing and they see opportunities and they know that services to product game and they start shoving it over, which is a form of their own capital. But these days, to get into a market, I have my Practical Founders podcast. I've interviewed over 130 founders. You don't need millions and millions and millions to build a product to get you to start a revenue, minimal sellable product. So it's 200, 300, 400, 500,000. You don't need $1 million to create a product that gets you into market in most vertical markets and horizontal niches. So some people are quitting their day job and coding it themselves. Some people are, getting people overseas to code it. AI is going to help you code it faster and accelerate all of that. So there's all kinds of ways they do it. So, but they're generally starting with a place of, I'm going to spend my own money to do it, which means they're more disciplined about getting to product market fit and go to market fit faster, right? It's their own money and they get to the bottom of it. They can't delude themselves too long. So, yeah, some get angel checks, and that's another practical form of funding. And, that isn't the big, institutional funding, preferred share scheme.
It does feel like we're still talking about two ends of the spectrum, kind of the bootstrap versus the traditional VC. And I'm wondering how we get to the middle, because if I think about what you described, traditional VC's got the loudest voice, right? So they can dictate, they got the most money, they have the loudest voice. It's the most traditional model where they can say, this is what it is, the triple, double. Here's all this money we throw at you. You go to an incubator, you come out
just what you do,
right? Like this is what you do. And founders get that. And we even see it when they pitch us, like they try to pitch towards those expectations. And we're like, well, that's not us. Right. And then, so that's one end of the spectrum. The other end of the spectrum sounds a lot like, frankly, a lot of the LPs in our LP base who founded traditional companies, an HVAC company, a real estate company, whatever it is.
Main Street company.
Yeah, a Main Street company. They founded these businesses. They made a ton of money in those businesses. Either they cash flowed them for 2 decades and then sold them, or they still have them and they're just making a ton of cash flow, whatever. The practical founders that you described sounds like that in the software business. So how do we educate people in the software business about actual optionality, right? Like maybe it's not full VC. It's not just you and you cash flowing it and bootstrapping it, because, there was this play for growth equity for a while. That's a different thing. Maybe that's still a thing. I don't know.
Well, that's what I've been dedicating the last 3.5 years of my life. And before that on LinkedIn, waving my hands about it. There's bootstrapping isn't, bootstrapping meaning self-funding, no outside funding at all, is just one of the flavors of it. And that's a simple bumper sticker that you got a crowd advocating. Maybe Jason Fried was the poster child for that, saying, here's how I did it. I don't want any. And he has outside investors that gave him some money. So Jeff Bezos and the rest. But you're right. The VC funded game, whether you go to the ecosystem or you go to the universities, you go to the media, you go big or go home, the clapping for the funding and so forth that's just dominant. And on my podcast, everybody's doing it every way in between, including bootstrapping it for 10 years and then doing VC funded and growing. And, there's all kinds of ways to do it. But from the founder perspective, it works for them first as opposed to for an investor.
Yeah. And that's where I think, you're seeing a need for VCs who think different within the space as well, right? Like even VCs that will entertain a 10-year-old business that now, reaches an inflection point at scale. I think on both sides, you're going to start to see flavors of those financial models emerge that, that meet market need. I mean, that's ultimately like how the free market works, right? Like you've got a demand for a product and someone devises a solution for it. And so, I mean, that's at the core of even our thesis is like, we look for optionality. It's not uncommon for us to work with companies that, are on a path where a Series A might be the last money that they intend to take and then, move to a profitable business model. Again, we're looking for an exit and a liquidity event for our money, certainly. So there's even flavors in there. But when we started getting into these two boxes, I think that's where, you just do a huge disservice, to the market in general. And that's where I think all this diversity is really coming from is a backlash on, hey, I've got to be either black or white in this equation.
Well, institutional VC funds, you raise $500 million or $1 billion. It's hard to raise a small fund, in your fourth fund, and, that whole game, the fees and everything else. They have a fiduciary responsibility to make enough bets that can pay off, for their returns, and meaning their net returns, that 70% are going to churn out. So it's hard to be practical about it. Like I tell founders, like you're trying to figure out what game you're trying. Your first rule of the game is to figure out what game you're playing, and your VC know what game they're playing. It's in their legal docs. It's the expectations. It's in the math of how they're going to make their money back, and it cannot be defied. So there's all kinds of creative, I call practical funders in between, like you guys that have different ways of doing it, different expectations. You don't have to keep raising hard. And I mean, if you raise $50, $100 million, you have to get out for $500 million, $1 billion, pretty quickly for everybody to be happy. Otherwise, it's no fun for the founders and everybody in between. So it's pretty rare to find in between angel, friendly angels, donations, and institutional VC funded. There's not a lot out there. Growth equity and private equity show up in more practical, and all the variations in between. So are you guys like let's say, early stage growth equity, meaning we'll help fund and help you with our go-to-market platform, but we don't expect you to be a billionaire, $1 billion outcome, and you don't have to continue raising as fast as possible?
Yeah, I mean, ultimately, our entire model is kind of predicated on businesses that can become at least $50 million businesses. And then that opens up optionality for exit because we're vertical focused, like strategic acquisition or even private equity is a highly attractive exit point for us, and kind of operating on this mid timeline. So if you talk to most VCs, they're talking about a 10 to 15 year timeline with, as we talked about, like an IPO or a very large private equity transaction being the end game. In 3 to 5 years is our desired outcome. And so in order for that clip to work, once you're starting from $1 million in ARR, yeah, you have to be growing rapidly, but it's not growth at all costs. And so that's kind of where you're balancing, the founder's expectations versus the product and the market versus their go-to-market channel, which obviously we're looking to augment, as we find that's a moat in and of itself. But the interesting thing is, I still find, and this happens on both sides, that there is a self-imposed time constraint on what we're essentially talking about here, which is developing a relationship and understanding if everyone is on the same page. And we get a lot of looks at a lot of deals where people are like, I need to close quickly. And it's like, well, we just had one phone call and you basically invited me to invest in your business.
Are we back to those days again where they got to close a deal in 2 phone calls? No, come on.
Well, I think you're also seeing a lot of extension, you know what I mean, based on folks that took investment in 2020, 2021, the runway's up, or, something happened in the business. And so now folks are running out of money out there as well, which is obviously a risky game to play on the VC side as well. But like, you've got to spend some time, in my opinion. I'm curious on what you guys think as well. But, it's just like hiring. We had an episode around hiring and kind of diversity and inclusion within the workplace and so on. And this, it all came down to, this is a relationship. And the more that you recognize that, the better off that you're going to be, and the more transparent. For me, the same exact things persist in taking money from someone, which I would argue is one of the most intimate things that you can do, and indentures you into a very close relationship.
Well, one of the things, Justin, that I think would be an education for a lot of founders, in my opinion, is, a lot of the deals, especially the deals we do, are syndicated by more than one, right? You probably have a lead investor, but there's more than one, and we're one of those one. I bet the founder doesn't know all the different underwriting criteria for all the different people in that deal, right?
Well, they don't even know the value adds that exist out there. Like, I've had conversations with founders explicitly like, hey, calls me up, hey, I need a recommendation for a law firm in the US. And it's like, do you know you've got a value add investor on your cap table right now that is their value add, is like back office and legal, and no idea, right? And I think that's what even gets murkier in syndicated deals, as you're referring to.
Yeah. Just one of those things where, everyone has probably slightly different underwriting criteria, and that could mean something different for you at different inflection points, right? Like, you could get to a point where it's time to raise. You don't want to dilute that much, but you might have hit the underwriting threshold for one of the partners in your deal, and buying them out is a viable option because you don't dilute yourself, right? Like, chances are they don't know that even exists, right? So I think just those types of things, to your point around optionality, Greg, that's where understanding how your syndicate's put together, if you're raising money, what does that look like, is super interesting for a lot of folks.
I just love when they give you a pro forma, and it's always up and to the right, but there's not really no plan how to get there. And so they don't have a sales leader. They may still be founder selling. They want to triple their revenues for the next year. And, that's, I think, to Justin's point, like, if we were to take everything on face value and just, one call, throw some money, it'd be easy to do. But once you start digging in and you get a few layers deep, you realize that there's really no plan except for a spreadsheet.
Yeah, the classic growth equity minority investor in practical companies that are break even, slightly profitable, growing about 30%, have a runway to, go 3 to 5x in 3 to 5 years in revenues. That's over 5 million, usually headed towards 10 million ARR, where the factory is pretty visible. And you can get in and see it. You can ask your 5 numbers and get there pretty quickly. But you guys are doing it really early. Like, how do you make judgments about this other than to say it's a big market, there's a hotshot founder, that they got a story to tell, they'll raise as much as they can, the classic early stage VC venture thing. How do you guys, talking about relationship and time there, how do you guys judge opportunities so early?
Yeah, it's a great question. So you led with market, which I think is like a tried and true and accurate VC stereotype, which is far less of a signal for us. Like, there are minimum bounds that we look for, right? Like, do you have, a at least a $500 million market cap potential, in that market? Sure. But like, not the bigger is better aspect. In effect, I think even with our model, that can be an inverse driver of success for us, because we need, to answer your question succinctly, like, we spend a ton of time on go to market. How do those sales cycles work? Where are the deals coming from? What are your buyers saying? How well are those converting? How well are they moving through the funnel? Just how are you thinking about that entire motion? And then certainly like the biggest, signal that we can find that really gets everyone excited is what is that, either potential for or presence of a partner ecosystem. And with a lot of our vertical stuff that we do, there are in fact strong partner ecosystems already at work there. And, not only provide a shortcut to market, but provide an outsized value add to the ultimate end user. And those are really where like the whole flywheel concept for me really starts to yield a lot of fruit to where, that 1+1 = 10 on the customer value side. Everyone recognizes that, and they're creating efficient routes to market that aren't going to be your typical cost per lead, let's battle it out for eyeballs type of situation. So a lot of time on the go to market front, and obviously there's, with us there's a lot of founder fit on, do I want someone else coming into my business and really advising and helping to take the reins here. Not when I say advising, there's so much pollution to that term, not from what you would think of as a typical VC, but really as a peer within the business. Now, yes, there's a weird relationship because we have invested in that company as well. But like, right now we've got Josh in a business that like is running go to market as effectively an interim CRO. And like he's in the trenches with those folks every single day. And you need a lot of founder buy-in and really team buy-in as well to foster something like that.
Yeah. Yeah, not every founder wants to invite hotshots into their business.
Yeah, correct. Dialing in on that persona that, because founders do say things just to get a round close as well. Like dialing in on the real fit there and the personality matches where we put a lot of thinking and effort. To your point, drastically different than other VCs.
Yeah, I was just gonna say, even in things as simple as knowing where we can be successful. And this is a dramatic example, but B2B versus B2C. Like, I don't know how to take a B2C company to market. So how could I invest in it if I can't help? Right. And then even in B2B, we talk about vertical, but even within vertical, there are subsets and nuances to how they would sell that just may not be a fit for me. Like we're actually doing one right now, probably not my strongest sales suit, but Justin's it is because he's done it. He's been there. He sold it. Right. So as long as we have that confidence that at least within our group, we know we could take it to market, there's some extra added security there, even though it's still a risky business.
Yeah. I mean, we literally just turned a deal down this morning. Founders have done, this is their third go around, 2 unicorns that they've created. And we're turning this deal down because we don't have the capacity. Like we're also closing another deal literally as we speak. So like the model and kind of maintaining the viability of that model is hyper important to us. I don't know a lot of other VCs that would make that type of decision because they couldn't work for free. The confidence and the conviction that we have for this model and how it provides value within that 1 to 10 journey is just something that we have to, stay true to the North Star there.
Yeah, I mean, just having a very defined thesis allows us to say no to a lot more things that would be hard to do just because it doesn't fit in there. So, and I think it's hard. I really like this one that we had to pass up. It was part of the last organization they're in, so I've got that track record. But I think, when it comes down to it, you've got to make sure that we're aligned there, and then they fit into our model.
How many deals do you guys do a year?
3 to 4. We could do a max of 4.
Yeah. So to say you're for a class of, founders and go-to-markets and growth rates and B2B SaaS is an exaggeration. You're really for, a pretty specialized subset of it that is a perfect match for what you guys are doing.
Exactly.
So, yeah, that's right.
And the other strange thing is I'm seeing, so we also invest in a very, atypical way, right? Like we don't have a fund for the explicit reason that like with our model doing 4 deals a year would not allow you to deploy capital in a model that also makes sense from, finance, like the amount of fees and so on that you need to take in to support the business. It just would be unsustainable. And that, that was a decision because of our value add. I will say that strangely, I've been talking to a lot of our VC partners who are, there's different reasons for this. A lot of it is market conditions. Some of it is, getting later stage in their career and so on. But I've had more than a dozen conversations with folks, very respected folks who are saying, I don't know if I'm going to raise another fund. I think I may just do you guys' model and do SPVs for the opportunistic stuff that comes along. Because the decision making is just, more confident at that level. You're evaluating everything on its own merits, and you don't have money sitting on the sidelines, and you can call it in based on the shared confidence in the potential for that business. So I do think, again, I'm seeing a lot of like just diversity start to emerge in what was a non-stratified area before.
And do you guys have a fee structure in
We do.
your world?
Yeah.
Okay. Off
Yeah,
your
I mean,
SPV. You're not burning to go invest because you have a clock started on your fund.
Correct. Yeah, we have a fee structure that is very typical. We have a management fee and then a carry. But if we try to survive on management fees, like we wouldn't be able to, right? Like it's not something that sustains the business, and that I think is an incentive that it creates a lot of alignment with founders and their business, because we don't have a $150 million fund where people are earning millions of dollars in management fees, and then maybe something happens. Like we all need that to participate in that outcome for everyone to be successful, us, our investors, and certainly the founders and their teams.
What are you guys seeing out there? I see a lot of the bootstrap founders, practical founders that want to stay light on the funding so they don't have to go too long, too late, and they can maintain control. But do you see a new wave of AI first software companies being, the myth of the 3-person startup doing 10 million, or the new possibility of that? Do you see that the new AI first companies being more funding oriented or less funding oriented, last few months?
The number one equation in terms of should I take venture capital money or some other, versus some other route to market, is a strong element of market timing. And I do think AI has really introduced an element of unpredictability to where, maybe not, but man, the opportunity cost of missing out on it is perceived to be insurmountable. So, if you need to get in market first with something that no one else is doing, and we've got a couple of these, category creators in the portfolio right now, there's a strong business case for, we need to get this in market and we need to run as quickly as possible. Now we're still going to look at that in terms of, okay, do you know what those routes to market are? Are they, have some element of validation already? And okay, can we add fuel to that fire, and can we add value to the business and so on? But I think that market timing has to be a big consideration on just, the decision to dump fuel on the fire, or maybe accomplish a slower burn.
Yeah, Justin had mentioned I'm embedded in the portfolio right now, and I had this explicit conversation with the founder recently, which is, listen, if we're saying and marketing that we're an AI first company, at some point we have to drink our own Kool-Aid, and that's not just customer facing, that's almost internal, right? So how does our product support the business in the business, not just externally to the customer? And excitable founders get excited real quick. Oh yeah, that's a great idea. I'm like, don't change the business today, but thinking about as product iterates, what do we do with that internally? Does that change how this piece of the business is staffed? Does it change our margin here? And it really was an interesting conversation once you reined it in a little bit. But yeah, I think there is a ton of opportunity to get more efficient with your cash, leveraging AI, but doing it in a smart way. And your product may already be solving some of the problems for your customers that are problems in your business. So I think thinking through that lens is super interesting.
Yeah, I do. To your original point, I do think that, where AI is at right now, realistically, is at a point of augmentation, to where maybe I don't need 10 individuals in my CS department, but I still need 5 of them. But I need those 5 to be really, really enabled by technology, and to add, which is, this last point is what I think is really the opportunity, and also reflects the state of the market and some of the reaction to AI. Like, we have to be able to provide hyper value to those customers. So where, a QBR or an annual review used to be like, show up and, hey, what are your strategic goals for the next 12 months, right? Like, no, we're using your data to uncover opportunities for your business that we have line of sight in that you probably don't. and it's value creation on behalf of the customer. That's what I think the new expectation is. So I don't think, the 3-person, $10-20 million company is realistic, but I think how you deploy human resources and the expectation of them is going to be greatly, just revolutionized by the AI concept in terms of what we expect employees to bring to our customers, bring to their job, and just a lot of that kind of dead weight that we all have known as dead weight, just manual process BS that is, data gathering and, someone inputting things in the CRM for someone else. Like, it's just crazy. Like, we never needed that. It was never a value add. And I think that's where AI is probably going to, have a feast here in the short term.
Yeah, for the practical founders I work with, they're adding AI incrementally and practically in useful ways into their product. They're not stopping everything, saying we're going to be AI first. They're not just waving AI out there, but they're also using it in their business to get more efficient faster, right? Get more leverage out of their business faster. And then we're back to the choice of how fast do you want to grow and what do you want to do with those extra dollars? Because you could say you could be 10 times more efficient and still need to raise money because you're trying to grow so fast. But most of them are trying to grow faster, stay independent, right? They're getting their leverage. That's just a personal choice they have, generally speaking, until they get to growth equity or private equity or whatever those turns are. So yeah, I see it in all of our businesses that I'm working with and practical founders land. They're using AI to have more optionality and more efficiency and more leverage.
Greg, I'm curious, in that vein, and kind of as we wrap up here, is there a dominant use case in the cohorts that you're working with for AI? Is anyone coming to you saying like, hey, yeah, we're, really common that we're eliminating our front end sales teams, our SDRs and things of that nature. And we're deploying this tool and it's just blowing the doors off. Are there any kind of, interesting?
I don't think there's anything revolutionary there. They're saying we can use it in customer success and support, and our, chatbots are starting to work, right, to take away 40% of the, the easy questions and manage escalations better. They're starting to use it in marketing, and I think some of this automation of pummeling spam on LinkedIn and the rest with automation is a net zero game in the long run. But you could argue people get an advantage with that. A lot of people are creating great content very quickly, and these are experts in their verticals. And now they have AI tools that get them to create content that works, top of funnel, middle of funnel. And everybody's saying we are using it to be more efficient with our coding, our engineers. And so everybody's got something up their sleeve. There's a range of, it really helps us and we don't have to hire as many people, to, yeah, we're playing with it and it's, it's useful, but we still got to write the code.
Yeah, I think, and we've got one founder that did this recently. The intersection of pain, with high levels of prevalence, with low levels of complexity, which are strangely prevalent in a lot of businesses. Like, one of our founders realized that, like, and this is it truly is a predictive platform, right? Like, and it's focused on in the fleet maintenance world, like predicts downtime, allows you to cluster service in ways that save real time and money, keep trucks on the road, right? But one of the high pain points is just, importing paper invoices, paper work orders, paper receipts, and so on. And like, they were finding that, like, yeah, we're seeing this, like, people are talking about this pain everywhere we go. It's something that anyone's going to buy a software based along, but it was a feature that they could spin up very quickly, augment their solution set, and create a massively more sticky product, because now you're not just integrated into a preventative or an optimization workflow, but you're integrated into a daily workflow at that point, which strangely none of the competitions that had. So I think it's things like that where, you're seeing a high degree of value with a fairly low lift, that, again, first mover advantage has a big role in that as well.
Yeah, I think I love the opportunity to replace labor with efficiency in these workflows and so forth. Software has mostly been helping people do things better for all these years, helping accounting teams do better accounting, and it used to be on paper, now it's on, the computer. But to, manage all the paperwork and to manage the workflow going back and forth, to manage the analytics and assessment. These are really powerful things that are going to take, there's huge value props in that area.
Yeah, it's kind of like low level, highly repeatable, high paying tasks that we shouldn't have been deploying human capital against in the first place. I would hope we expect more from humans, and they desire more as well. So,
well, they probably like those whatever expense management, accounting, administration jobs, that give them a few weeks of vacation a year or whatever. But
difficult to build a high growth company with some of those anchors though. So. But so Greg, I think that's kind of, we're at time, but really appreciate the insight. I mean, if you had to summarize, what you're hearing from both sides, is there a nice meaty concentric circle?
Well, there's many ways to play this game. It's a big and vast industry, and so choose wisely. You choose your founders who are choosing to build businesses that fit your style and your approach. So founders and funders should choose very wisely, right? And I think they should be understanding of all the options that are available to them. And funders are, but founders generally aren't. So that's what I fear for founders, is they take the funding drugs before knowing really the implications, and not everybody does it in that kind of way, before they really understand what they've got and what's the best fit funding for them. So yeah, you guys definitely play right into that.
I think fit across the board is the commonality here, right? Like find the right, not just business model and financing options, but find the right partner, regardless. And I think all too often VCs exchange that for excitement, and everything kind of gets fast forwarded in that process. But the happiest founders and capital allocators that I run into are folks that really know one another and we're aligned from the get-go.
Absolutely.
Cool. Well, thanks everyone for again joining us for another episode of the Cheat Code and Friends. You can, of course, find this on all available podcast channels and YouTube. If you haven't subscribed, please do so. Give us a like, give us a share. We greatly appreciate it. Mr. Greg Head, thanks for joining us. Very much appreciate that as well. And we will put links to the Practical Founders resources and just your site in the description. Really appreciate you joining us here today.
Thanks, guys. Good to see you.
Thanks, everyone.